This is Horizons Middle East and Africa, our top stories this morning. Asian stocks rallying on signs the U.S. and China have hammered out a trade deal. Focus turns to the meeting between Presidents Trump and Xi for final approval.
We created a framework for the two leaders to discuss on Thursday in Korea.
We are live in Riyadh this week for the Future Investment Initiative with the world's top bankers, world leaders, and executives gathering to explore the future of global investment. We'll be speaking to the CEO of Barclays exclusively at 9 a.m. Dubai time. Plus, vote counting is underway in the Ivory Coast. President Alassane Ouattara is expected to win a fourth term after a disputed election that excluded key opposition figures. But for now, it is just gone past 8 a.m. across the Emirates, 6 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg, in for Jumana Bersechi, who is in Riyadh this week for the 9th annual FII conference. And boy, what a week it is already, even though it's just Monday morning, starting off with quite a bit of risk on sentiment. As we mentioned, potentially we're getting closer to a trade truce between the U.S. and China. We are awaiting that meeting between President Xi and Trump later this week. But comments over the weekend suggesting potentially we're headed into positive territory, and you can see that reflected a bit in the markets right now. And that also coming after we got that cooler than expected CPI print in the U.S. on Friday, helping to lift U.S. equities to new highs at the end of last week. We're starting off here, as you can see there, S&P futures up just over 0.7%, and that is also following what has been a relatively positive session for the Asia markets. If we take a look at the 10-year yield, we are seeing yields back up right now. The U.S. 10-year yield at just about 4.025% there. But if you do recall, just a few days ago, we were witnessing U.S. 10-year yields actually reaching the lowest levels since April. So we'll wait to see how the rest of the week progresses, especially because we do have central bank meetings later this week, including the Fed. Right now, we're seeing Brent crude pairing some of the gains that we did see earlier in the day right now. But still, we saw oil rebounding from a 5-month low last week after we did hear about the U.S. sanctions on Russia's two biggest crude producers. Right now, we are seeing Brent crude to trade at about $65.96 a barrel. And gold, take a look at where gold is right now, pulling back from some of the highs that we've been speaking about over the past few weeks, down just over 1.18% there. Potentially, we'll see further decline if, in fact, we do see a flock away from safe haven demand, given some of the potentially positive signs that we're seeing in the global markets and some of the risk taking or a bit of taking from positive territory from some of the other investors who are potentially trying to cash in on some of the highs that we've seen for gold. Let's just finish on copper because we are seeing the metal advancing towards new highs. Potentially, we're going to see that even continuing as, again, we do see continued positive sentiment in the global markets right now. There is still a bit of concern as far as mine disruptions go and also potentially softer demand in China. But right now, we are seeing potentially optimism around the energy transition helping to lift copper. But we were mentioning gold there. And just take a look at the divergence that we're seeing between gold and Bitcoin. Gold pulling back, Bitcoin obviously creeping back up there as we have seen over the past few days. Now, let's get back to our top story, though. In a sign of thawing relations ahead of the Xi-Trump summit this week, U.S. Treasury Secretary Scott Bessent says he expects China to defer its rare earths export curbs. This comes as top trade negotiators for the U.S. and China set the stage for their leaders to finalize a trade deal.
I'm also anticipating that we will get some kind of a deferral on the rare earth export controls that the Chinese had discussed.
Okay.
But again, this will all be, my counterpart, the Vice Premier, and I have set the framework, and it will be up to the two leaders to discuss the final terms.
Let's bring in Bloomberg's Avril Hong, who is in Kuala Lumpur for the ASEAN summit. Avril, thanks so much for being here. Give us a sense of what the sentiment is like there on the ground, given some of the rhetoric that we've been hearing over the weekend.
It's great to be here, Jen. And you know what? The sentiment on the ground is very, very positive. Don't forget, coming into this week, there was some uncertainty about whether the leaders of the US and China, Trump and Xi, would even be meeting at South Korea's APEC gathering. And what we are actually seeing, as you can see on your screens, there is actually Trump just a day ago touching down in Malaysia, being received by the Malaysian Prime Minister Anwar Ibrahim, doing a little dance. So to your question about the sentiment on the ground, I think those pictures speak for themselves. Now, to the details, because of course it is about deal making and the idea that the top US and Chinese trade negotiators are paving the way, teeing things up in order for their bosses, Trump and Xi, to finalize some form of a trade agreement or a trade deal come Thursday. And they have been hard at work. If you think back to this weekend, 2 days of negotiations where the Chinese and the US delegations have been engaged, and some of these key issues have been addressed, or at least there have been positive tone coming out from that, including on fentanyl, upping the soybean purchases, and the key one, which you talked about just a short while ago, the rare earth restrictions delays. Of course, this is a critical mineral that goes into a multitude of advanced products, and it has been seen as China's leverage in the trade war. So absolutely crucial that at this stage, the US, at least they feel they've gotten some form of commitment from the Chinese side that there will be a delay in the rare earth export restrictions, Jen.
Avril Hong there at the ASEAN Summit in Kuala Lumpur. Avril, thank you so much for that update there. Let's get some insights into the oil markets with our next guest, who is among the most influential people on the world energy scene, and he's joining us exclusively from Singapore. Fatih Birol, the Executive Director of the International Energy Agency. Fatih, thank you so much for being here. So really significant day as far as what we've seen over the past few hours and days. Give us a sense of how you think a potential trade deal this week could set the scene for the oil markets. Let's just start there.
I think when we look at the oil markets, leave aside today's events, we see a surplus of oil production. A lot of oil growth coming from the Americas. I call them the American Quintet: US, Canada, Brazil, Guyana, and Argentina. This growth from production is much stronger than the growth of oil demand. Oil demand growth is getting weaker and weaker as a result of the Chinese economy changes its character from a heavy industry-based economy to a lighter economy. Plus, the electric cars are eating a bit of the oil demand growth. So to put them together, strong growth of production coming from Americas, plus the weaker demand of oil means downward pressure on the prices. We are about $60 in the middle of so many geopolitical tensions in the world. Middle East, Russia, Ukraine, and others. It is exactly what we said 1.5 years ago. It's a good news, I mean, for especially the oil importing countries, for the consumers to have lower, moderate oil prices. And today's news about the China-US trade deal may give a slight boost on the limited boost to the oil prices, but in general, I expect rather moderate prices in the next days and weeks to come, bearing a major geopolitical events.
What could that potentially be, Fatih? And we were just a few days ago talking about the sanctions on Russian oil. Or do you see further potential sanctions on the table that could be a major event?
Yes, it is under discussion with Russia or Venezuela or Iran, for that sake. There are discussions. But when I look at the markets, there is ample production, spare production capacity. So unless they all come together in a big time, I don't expect a major shakeup in the oil markets, thanks to growth of production coming from the Americas, and also a change of oil production policies of OPEC Plus countries. And we shouldn't forget that oil demand growth is slowing down. As a result of all of these trends, I expect rather moderate oil prices in the next days and weeks to come.
What does that mean for the IEA's predictions on what 2026 could look like, Fatih?
I think 2026, again, we don't know what will happen in the geopolitical scene. When I look at only the market trends, oil supply, oil demand, macroeconomic environment, looking at only these factors, I expect rather well-supplied oil markets and prices being on the moderate levels, which in turn, good news for the inflation numbers in many countries, for trade-off balanced numbers, especially countries in this very region where I am now in Singapore.
Fatih, can we talk about LNG demand, and in particular China, and potentially how that factors into increased demand over time? Are you concerned potentially that, in fact, we're not going to see the demand that many people had anticipated?
I think we will see a demand growth coming, but the supply growth is much stronger than the demand growth. As we have predicted 2 years ago, as of 2026 and until 2030 at least, we are seeing a major new wave of LNG export capacity coming to market. So whatever the world has been in the last 30 years, 50% of it will come to markets in the next 5 years, coming from US, Canada, Qatar, Australia, which means that the gas markets, LNG markets, will turn from the markets of sellers to the markets of buyers, which in turn means that we will see downward pressure on the LNG prices, even though we expect a healthy demand growth, but the supply is much, much stronger as a result of the LNG wave, LNG production wave coming to markets.
Let's finish, Fatih, on coal consumption. I'm sitting here in South Africa, which is still trying to, in fact, figure out its own transition. Do you think we have reached peak coal consumption?
I think the coal demand is growing in some countries and declining sharply in others. But in general, when I look at the current market trends and the policies of the countries, this year or next, we still expect the coal consumption being on the plateau. Everything depends on the China policies. China consumes more than half of the global coal consumption. And what China will do, what China will decide, will have an effect on this rather expectation of ours, namely having a plateau of coal consumption around the world. If there is a dry year of hydropower in China, it's a different story. If it is a rather a rainy year, if they can produce a lot of hydropower, it's a different story. But looking at the future, I think China will make a lot of addition of solar, nuclear power, renewable storage capacity. Therefore, the share of coal, even in China, will decline.
It's fascinating times, absolutely. And we appreciate you starting us off there. Fatih Birol, Executive Director of the International Energy Agency, speaking with us there on all things energy markets right now. Let's continue on and dig into the markets, because, as we mentioned, it is quite a busy week that we are shaping up to be. Head of Equities at Terebinth Capital, sitting next to me, and Sebastian here. And thank you so much for being here in studio. Let's just start with this potential truce between the U.S. and China, because that seems to be really what's driving sentiment in the markets. Are you positive that this is really a breath of relief?
It is a breath of relief. It will be seen as a trade de-escalation, so you can see that impacting gold. I think, markets would like that, and there would be risk on in that environment. So I think it's definitely, a relief in that there's less uncertainty, and you should see on 1st November that 100% tariff not being implemented.
Is it premature, though, some of this sentiment, right? Because there are still a lot of factors that could change the direction of travel.
So it's about the horizon, right? In the short term, it is definitely positive. Some of the risk assets have recently pulled back, and this now fuels it in the near term. But I think the theme is that there's a de-escalation in that tension between U.S. and China.
Does that mean we continue to see exuberance in the markets? And how does it sustain itself right now? Because we were talking about U.S. CPI, that helping lift U.S. equities. Does this remain, though, continuous?
I think in the near term, it is positive for risk assets. With U.S. CPI, what we saw is that the cooling of the U.S. CPI figures, but the cooling of the job markets means that there's probably going to be a 25 bip rate cut this week while the ECB holds. Alongside that, you have the GDP figures that will come out, and despite the shutdown in the U.S., you should still see really strong numbers coming out of the U.S., rate cuts coming through. That's good for all equities, especially emerging market equities, which are dialed up more risk on. And then, it is good news in the short term. In the longer term, moving into 2026, it's really striking that balance between the Fed's dual mandate, the growth versus the labor market.
What's the risk here, though?
The risk here is, firstly, it is that something should change between China and U.S. Because that relationship is very competitive still. The other risk factor is if anything changes from a Fed rate cut expectation. As it stands, if the rate cuts should come through, that's positive for all equities, EM equities, and in a world going forward that the dollar also weakens, then that's really good for emerging markets, because then you have an environment where you're having slower growth, so the Fed is cutting. For example, the South African Reserve Bank might choose to hold, and then that policy rate differential is good for the rand. Additionally, you would also have this growth lever coming through with EM versus DM, and that benefiting risk assets.
Is your expectation then we'll continue to see further weakening of the dollar? Is that your base case right now?
Next year, we are expecting the dollar to weaken. Right now, it is quite challenging, but if you look out 1 year out, I think the dollar should continue to weaken. There are still aspects that favor a dollar weakening in the next year.
Which would be?
So there is the debasement aspects. You are still seeing central banks buying up gold in favor of the dollar. Granted, right now you're having the risk on, so you're seeing a bit of that rebalancing. So I think that's positive for the dollar weakening. Then you also have generally an environment where emerging markets are starting to compete for capital. And if that growth differential shifts more to emerging markets where US is slowing down, then you should see flows into emerging markets like South African equities.
Is that what you and your team are doing at Terebinth Capital? How are you thinking about asset allocations considering some of these outliers out here?
So we've been fortunate that we've been in part of the momentum trade. So we've been exposed to via Naspers Process. So Naspers owns Process, and Process then owns Tencent, which is this China story. So we have seen that rally, and we have taken some profit there, but still confident on that cluster. In gold, we've taken profit also, but still from a longer term view, think there is a potential for the gold to come back when gold prices pull back like this. You can see central banks buying, so that is something possible. But we've taken profits, and we've now started to allocate in the past couple of weeks to the domestic cyclicals, which are just too cheap to ignore.
Really, very interesting times, right? And Sebastian, head of equities at Terebinth Capital, joining us here in studio in Johannesburg. And thank you so much for being here. Now, coming up, private credit titans are jockeying for mega deals in Saudi Arabia. We'll explain what's behind the rush next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. South Korea's president says talks with Washington on a $350 billion investment pledge remain stuck on all the major details. We spoke to Lee Jae-myung ahead of his Wednesday meeting with President Trump on the sidelines of the APEC summit.
The negotiations between Korea and the United States are proceeding in two areas of security and economics simultaneously. Negotiations in the field of security issues are going very well, but negotiations in the area of economics, especially trade, have reached a preliminary agreement, and we're in the process of hashing out the details. The discussion is ongoing and there are some differences of opinion, but the delay does not necessarily mean that this is a failure. We already have a comprehensive agreement, and we're currently working on the details. So I would appreciate your patience.
When it comes to Japan's deal, there have been some divergent interpretations. Is South Korea trying to make it more specific than Japan's? And if that's the case, could that become more burdensome for Korea later on?
Korea is not Japan. I do not fully know what deal the US and Japan have struck, but from our point of view, we have our own circumstances, and we will reach a rational result that suits us. Of course, the example of Japan or Europe could be a base that we can refer to, but in the end, we must find a way which takes into account Korea's circumstances, that is acceptable to Korea, and also helps the United States in its manufacturing renaissance. As we search for a mutually beneficial path, there will be differences as well as alignment of opinions.
In finding common ground, could the size of the U.S. investment fund become smaller?
The method of investment, the amount of investment, the timeline, and how we will share the losses and divide the dividends, all of these remain sticking points. The US will of course try to maximize its interests, but it must not be to the extent that causes catastrophic consequences for South Korea. The United States is the leading country in the world when it comes to democracy and rationality. South Korea is an ally and friend of the United States, so we believe that we will be able to reach a rational result that is acceptable to all sides, and this is what has to be done.
A highlight of the APEC summit is the upcoming meeting between Presidents Trump and Xi Jinping. How important is this dialogue for South Korea?
When it comes to the supply chain, the world is divided into two blocks facing off each other, one led by the United States and one by China. Korea is situated both geographically and economically between these two. We are situated in between two grinding stones. It's a situation akin to having both arms pulled by China and the United States. This is both a challenge and an opportunity. We cherish our baseline policy emphasizing the Korea-US alliance and Korea-US-Japan trilateral cooperation. At the same time, we do not seek to sever ties or pursue excessive confrontation with China or socialist nations. Korea will continue to cherish and emphasize its alliance with the United States, and at the same time manage its relationship with China.
South Korean President Lee Jae-myung speaking to Bloomberg's Sherian. Now, let's bring you some of the other stories we're following this morning. Canadian Prime Minister Mark Carney says his government is prepared to resume trade talks with the U.S. at any time. President Trump said last week he's calling off talks and imposing an additional 10% tariff on Canadian goods. Trump was angered after the province of Ontario aired an anti-tariff ad featuring former U.S. President Ronald Reagan.
Canada stands ready to build on the progress that we had been making in our negotiations or discussions with our American counterparts. And we have a consistent focus in those discussions on doing the best deal for Canadian workers and their families.
And coming up, vote counting is underway in the Ivory Coast presidential elections. We'll dig into that next. Stick with us. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. Asian stocks rallying on signs the U.S. and China have hammered out a trade deal. Focus now turns to the meeting between Presidents Trump and Xi for final approval.
We've created a framework for the two leaders to discuss on Thursday in Korea.
We are live in Riyadh this week for the Future Investment Initiative with the world's top bankers, world leaders, and executives gathering to explore the future of global investment. We'll be speaking with the CEO of Barclays exclusively at 9 a.m. Dubai time. Plus, vote counting is underway in the Ivory Coast. President Alassane Ouattara is expected to win a fourth term after a disputed election that excluded key opposition figures. But for now, it's just gone past 8:30 a.m. across the Emirates. 6:30 here in South Africa. I'm Jennifer Zabasaja in Johannesburg, in for Jumana Bersechi, who is in Riyadh this week for the 9th annual FII conference, and will bring us plenty of interviews this week. But let's just get to what we are seeing this morning, because we are seeing quite a risk-on sentiment continuing after we did get that U.S. CPI print on Friday. That was softer than expected. Now over the weekend, as we were just mentioning there, potentially positive signs between the U.S. and China, as Trump and Xi head into that meeting later this week. That helping to lift global equities. Right now, S&P futures up just over 0.7%. And we should also note we do have the Fed meeting later this week. We also have a number of corporate earnings, tech earnings that we are waiting for this week. Potentially, we continue to see more upside for U.S. equities. The U.S. 10-year yield right now at 4.0334. Just a few days ago, you might remember we were talking about the U.S. 10-year yield reaching the lowest since April. Now we are seeing the yields back up, and potentially we continue to see that if, in fact, we do see more positive signs between China and the U.S. Let's take a look at Brent crude, though. Right now, we are seeing Brent up ever so slight, but still some positive signs, especially if we think about what we were just talking about with Fatih Birol earlier this morning, which is about oversupply in the market. And yet we are seeing oil rebounding from a 5-month low last week after we did get those sanctions from U.S. President Trump on Russian crude. Right now we are seeing Brent crude at just about $66.03 a barrel there. And gold has been a fascinating story over the past few weeks and months. But right now we're seeing gold pulling back from the highs that we've been speaking about over the past few weeks, down just over 1.2%. There. And what's interesting there is potentially we continue to see further declines as our Markets Live team suggests, potentially if we do head into a positive situation between the U.S. and China. Also, as our guest was just pointing to, we are seeing some profit taking. So potentially we do see more downside for gold right now at just about $4,063 an ounce there. And let's just finish on what we're seeing from copper, because copper is also experiencing some of the exuberance that we were talking about earlier today. It's advancing towards an all-time high, and yet there is still some concern about what this means for the metal. There are still concerns about mine disruptions across Africa and elsewhere, but then also softer demand. What does that mean for copper? And yet, potentially optimism around the energy transition continues to help lift copper up. So that is what we are looking at right now. But let's check in on how Asian markets are faring. It's been a few hours there with Winnie Xu in Hong Kong. Winnie, it's been a positive session, it seems.
Yeah, exactly. A really strong momentum when it comes to Asian stocks, especially after that latest development between U.S. and China. Now, you can take a look at how it's really boosting Chinese assets here. We can see how on the board that we have the Chinese assets, whether it's onshore, or offshore stocks, or even the offshore yuan, really getting a nice boost. And yes, there was a lot of progress made over the weekend, but investors highlight that something really important is that China is finally on the same page, and that they've also said that they reached that framework with the U.S. So it's really setting a positive tone ahead of the meeting between the two leaders. Now, sector-wise, we are seeing some gains when it comes to shipping stocks, but also soybean makers struggling a little after how China is now expected to buy more soybeans from the U.S. And offshore yuan, yes, we talked about how it was gaining about 2.2%, but also because of PBOC saying that they have this time around a stronger fixing. And now take a look at what's going on broader Asia market, because we are seeing that effect really translating into broader gains across the region. MSCI Asia, Japan, South Korea, all hitting their new record highs. And here you can see on the board, the Nikkei 225 actually breached that key milestone of 50,000, and the Kospi passed that key milestone of 4,000. So overall strong sentiment, and emerging markets actually rising as well after Trump said that he's made some key deals with some of these Southeast Asian markets. Now flip the board, we take a look at what's going on currency as well, because Asian currencies broadly strengthening against the dollar because investors are now preferring these riskier assets. So you see that the Korean won is leading gains here, but also China proxies, be it the Aussie dollar or the Kiwi dollar, also gaining ground.
All right, Winnie Xu in Hong Kong, walking us through the Asian markets. Winnie, thanks so much for joining us. Let's turn back to the region here. Vote counting is underway in the Ivory Coast, where President Alassane Ouattara is expected to win a fourth term after a disputed election that excluded key opposition figures. The election has been criticized as a setback for democracy after a constitutional change in 2016 allowed Ouattara to seek 2 additional terms. For more, let's bring in Bloomberg's Ndiro Oganga, who has been following this story. So, Ndiro, walk us through how pivotal Ouattara's re-election is going to be for the Ivory Coast economy and potentially even for political stability in the region.
Good morning, Jennifer. So for context, Ouattara's stay in power all these years is being attributed to his sterling management of the economy. And ever since he took power, data points to that. The economy is one of the fastest growing on the African region. They've been growing by about 6% annually. And this is one of the best growth numbers that we've seen in the region. And this growth is anchored on a couple of things. It's anchored on infrastructure. It's anchored on all deposits. And also it's anchored on sectors like mining. And because of this, we are seeing that their bonds are some of the best performing bonds on the African continent, yields below 10%. And this is a country where the cost of living is really low and the standard of living is really high. So to your question, it might not be pivotal, but it's a very essential re-election in ensuring continuity in the country. The president himself says that the next 5 years he wants to focus on infrastructure projects, expand electricity, expand mining, increase the contribution of manufacturing to the country's GDP. And this re-election has sort of been given the nod of approval by the markets, because if you look at their bonds that are due in 2036, yields have fallen by 70 basis points. However, there are concerns. While continuity is good in the short term, long-term projects, for example, mining and infrastructure that require credible systems, predictable political environment, stability, might be raising questions, because you look at the current state of Ivory Coast, there's no clear succession plan, there's oppression of opposition, and so this democratic regression, even though he has brought economic development, becomes a concern for long-term investors.
Can you speak to that more, Ndiro? Because that is one of the chief concerns among a number of analysts that I speak to. What does this mean about democratic regression in the region?
Jennifer, we are seeing it happen more and more and more. For example, in the Western Sahel, we've seen several military coups. And while it's supposed to happen where a military coup happens, there's a transition government and then a democratically elected government comes back into power. That's not what has happened. In the case of Guinea and Chad, we've seen the junta take advantage of the constitution, change it to legitimize their military coups and become democratically elected leaders. In Cameroon, in Togo, we are seeing democratically elected leaders again toy around with the constitution, become lifelong leaders. And so there is no punishment, or nobody is holding them to account. They can still go to ECOWAS, they can still have a seat at the table. And in the case of Ouattara, he can say, I'm managing the economy better. But in the long term, it's likely to have implications, because this is a country that is in the midst of chaos. And unless they have a clear succession plan, eventually President Ouattara is going to become a thorn in the flesh as much as he has been a good leader.
Yep. Bloomberg's Ndiro Oganga in Kigali, Rwanda. Ndiro, thanks so much. Let's expand the conversation and bring in Samir Gadio, the Africa strategy head at Standard Chartered. Samir, thanks so much for joining us. So Ndiro was just walking us through the scene right now, going as we wait for the votes to be officially counted. How are you assessing the current situation in the Ivory Coast?
I think the results were widely expected, so there isn't really any surprise to say. Now, there was a bit of premium in the Eurobonds, but I think that's probably going to be priced out this week. In fact, we have seen the Eurobonds kind of started to outperform a little bit at the end of last week. Now, it's possible that, you know, some investors might still worry about political risk, but generally speaking, I think most of the market has kind of been benign about these sort of risks. I think we haven't really seen any major unrest this time, unlike in 2020 or in 2010, for example, where obviously the situation was much more complex. Now, the key question is really what happens from here. And I think there won't be much change in terms of economic policy. So it's basically likely to be continuity. We will see focus on infrastructure, on export diversification, and as mentioned previously, so there are a number of key developments in this field. So, for example, oil production has picked up. There's a number of new discoveries. There's a number of mining discoveries that will probably make a difference. We will probably see growth remaining quite strong, but I think the key point is really whether we will see income inequality, some of the social challenges being addressed over the next few years. And they have to some extent, but obviously, you know, this is still quite a challenging situation in a sense, because when this administration came to power in 2011, effectively, there hadn't been any growth for 20 years or so, and these things still have to be faced even as to today.
Does the country still continue to be a prime investment destination for you and your team? What are some of the factors that you're considering here?
Yes, I think so. So Ivory Coast is certainly a focus of financial markets because it's a key Eurobond issuer in Africa. It's one of the few countries that is rated in double B territory. In fact, probably with room for one notch upgrade over the next couple of years. There has also been a pickup in FDI, in investment, in oil and mining, although on the mining side it's still at an early stage. Ivory Coast remains the top cocoa producer. So those are the fields that have kind of attracted investment. Over the past few years, we've actually seen a pickup in private investment domestically as well. 10 years ago, the Ivory Coast story was primarily driven by public investment, which still remains a key component of growth, but increasingly that's kind of switched with domestic private activity actually taking the lead, and that's probably going to continue to some extent.
All right, we will leave it there with you. Samir Gadio, waking up early in London to give us his assessment on Ivory Coast, Africa strategy head at Standard Chartered. Thank you so much. Now, coming up, private credit titans are jockeying for mega deals in Saudi Arabia. We'll explain what's behind the rush next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Private credit titans are beginning to jockey for deals in Saudi Arabia, where liquidity in the banking system has been drained by ambitious economic diversification projects. From giants like Goldman Sachs and Apollo to state-backed investors and smaller asset managers, firms are now positioning for opportunities in the kingdom. That's likely to be a hot topic as Wall Street CEOs prepare to gather in Riyadh for the annual Annual Future Investment Initiative Forum. For more, let's bring in our Bloomberg Saudi Bureau Chief, that's Christine Burke. Christine, thanks so much for being here. Give us a sense of what's behind this new push by private credit into Saudi Arabia.
Well, private credit is really a hot topic globally at the moment. So what we are seeing now is that this industry is getting its beginnings in Saudi Arabia. And really, this is down to two key things. The first is that banks have been facing a liquidity strain for a number of years now. They have been lending at an explosive pace for the last couple of years, just given the sheer amount of financing needs that are needed in the economy to drive the Vision 2030 diversification agenda. And what we are being told now is that these banks, quite frankly, have reached somewhat of a breaking point where they just cannot seem to keep up with the demand for credit. Already that has led to some of the first signs that we are getting of a pullback in lending across the banks, again, just due to this such a strong level of demand. And then the second thing that's at play here is really that all of the strain that we are seeing on banks comes at the same time that we are seeing the government in deeper budget deficits. The sovereign wealth fund is reprioritizing its spending. And so together, what this means is that there's just less financing to go around to drive the investment and spending that's needed on these economic diversification products. And so what we're hearing is that you've basically got all corners of the economy really looking for alternative sources of financing. And that has paved the way for private credit. I mean, private credit, even just a year ago, was non-existent here. But now, we just heard from Moody's, and they said that you've got the big guys like KKR sniffing around in Saudi Arabia, trying to figure out what kind of deals may be sitting here in this market for them.
Is that really going to be the focus, Christine, this week during FII? Give us a sense of what you're watching out for.
Well, certainly it won't be the focus, but it will be a focus. I think private capital in general is something that we will hear a lot of people talking about in the coming days, just given that it's no secret that the Saudis are in need of funding at the moment. There are more than half a dozen panels just tomorrow on day one alone that focus on private credit, whether that be private equity, private capital, venture fundraising. I mean, there'll be a lot of voices taking to the stage to discuss this. I think the bigger thing that may be up for discussion tomorrow really will be how the kingdom is prioritizing its spending. We know now more than ever before that the kingdom is coming up against some serious constraints, not only fiscal constraints, but capacity constraints and technical challenges on some of the bigger projects. So we have reported that the Sovereign Wealth Fund is, for example, looking at potentially shifting away from some of these glitzy mega construction projects that may not be done for decades. And really, it's going to be focusing on the years ahead on things like high-tech, smart manufacturing and artificial intelligence, and the things that will help Riyadh immediately become a more competitive business hub. So we believe that will also be a key thing. I think a lot of attendees will be looking for the government to deliver some sort of messaging as to how they're prioritizing their spending as we head into the third phase of Vision 2030 starting in 2026, because that'll be crucial to see what kind of deals exist for all the titans of Wall Street that are descending on Riyadh this week.
And we know you and the team will be doing some great work down there. Thank you so much for making time for us. Bloomberg Saudi Bureau Chief Christine Burke, thanks so much. Now, coming up, is gold losing its luster? As the precious metals decline continues, we'll discuss what's driving the drop next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Traders are tracking gold prices as progress on a U.S.-China trade deal saps haven demand. This comes after the precious metal posted its first weekly drop since mid-August, although bullion is still up over 50% this year. Let's bring in Bloomberg's Martin Ritchie, who is in Beijing for us. Martin, thanks for being here. So the market is apparently anticipating a positive meeting between President Trump and Xi later this week. Is that what is behind some of the moves that we're seeing with gold?
Certainly this morning you've seen a bit of a risk-on mood across markets, and that's never really good for gold. The prospect of a fairly sweeping trade deal between the US and China really blunts a lot of that kind of geopolitical fear and fears for the global economy that has helped gold to some extent rise to those really high prices, record prices this year, as you said, still up 50%. But it has to be said that the sort of correction in gold was already underway before the trade talks culminated this weekend. It has come down fairly substantially over the past week. I think that's more to do with prices had run up so high. There's a lot of froth in the market. Despite the fact that most analysts and a lot of traders still pretty bullish, I think there's a consensus that it had risen pretty fast. It needs to spend some time cooling off before any further gains.
So potentially that is what we are seeing with gold. Martin, let's talk about copper, because copper is seeing a positive day so far. Give us a sense of some of the factors that are behind some of the price action right now.
Yeah, so kind of slightly on the opposite side with copper. It has faltered a little bit in recent weeks, or wavered along with the ebb and flow of news and the trade negotiations. We're now about $50. That's less than 1% short of a record high for copper. Really, when you have this kind of relief rally for sort of risk assets, those linked to investment demand and manufacturing, if you have that relief rally following the trade news over the weekend, copper is going to join. So it's up quite strongly. But also, as with gold, there's sort of stuff happening otherwise as well. There's been a lot of supply disruptions in the copper market, which have helped keep prices elevated this year. A lot of mines having unexpected disruptions or accidents that have tightened supply a little bit. So that's also keeping copper at these very high levels.
All right, we'll leave it there. Martin Ritchie in Beijing for us. Martin, thanks so much for walking us through both gold and copper today. Let's take a quick look at where your markets are positioned right now. We are seeing a risk-on day, as you can see green on the screen, for U.S. equity futures continuing to trade near record highs. The NASDAQ futures up almost 1% there, and it's looking like potentially a positive day also in the Europe session. Eurostock 50 futures up just about 0.3%. And as we have been talking about throughout the show, a lot of the sentiment today is being driven by potentially positive news, excuse me, on the U.S.-China trade discussions. Still awaiting that official meeting between President Trump and Xi, but potentially it is a sigh of relief. The markets are anticipating a sigh of relief and some harmony coming between the two, especially after the past few weeks and months. We can also take a look at oil because we've been paying attention to the price of oil, pairing some of the gains that we saw earlier in the session, but still Brent crude up just about 0.4% there. Well, stay tuned for the next hour of Horizons. We are joined by the CEO of Barclays, CS Venkat, for an exclusive conversation. That is coming up next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks rallying on signs the U.S. and China have hammered out a trade deal. Focus turns to the meeting between Presidents Trump and Xi for final approval.
We've created a framework for the two leaders to discuss on Thursday in Korea.
We are live in Riyadh this week for the Future Investment Initiative, with the world's top bankers, world leaders, and executives gathering to explore the future of global investment. We'll be speaking to the CEO of Barclays exclusively in just a couple of minutes. Plus, vote counting is underway in Ivory Coast, where President Alassane Ouattara is expected to win a fourth term after a disputed election that excluded key opposition figures. It is just gone past 9 a.m. across the the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi, who is in Riyadh. Let's just take a look at what we are seeing from the markets, because as we were mentioning, risk on, especially after some of the rhetoric that we have been hearing from President Trump and the U.S. administration. Potentially, we're getting closer to an easing of trade tensions between the two nations. We'll wait for that meeting later this week. But still, as you can see from global equities, starting in positive territory, S&P futures up just over 0.7% there. And we should mention U.S. equities closed last week near a record high after that softer than expected U.S. CPI print. And it is a big week for markets. We are waiting for the Federal Reserve meeting later this week, and also corporate earnings. So still potentially more upside for global markets and U.S. equities in particular. The U.S. 10-year yield is up right now at 4.0353. You should remember just a few days ago, we were taking a look at how U.S. 10-year yields were reaching the lowest level since April. Now we are seeing some upside. Potentially, there is some vulnerability on the horizon, as our Markets Live team suggests, especially if we do see a tampering down of trade tensions. Let's take a look at Brent crude right now, pairing some of the gains that we saw earlier in the session today, but still up almost 0.4% there. We did speak earlier with Fatih Birol, who did give us some insight into some of the oversupply in the market right now. Potentially, we continue to see more pressure into the Brent prices right now, $66.20 a barrel there. And gold continuing to face more pressure, potentially some profit taking there, down just about 1% there. Let's take a quick look, though, at copper, because we've also been talking about some of the moves in copper. Gold facing pressure. Copper, though, seeing some upside and just about 1%, less than 1% near its record. But still, there is some concern about potentially softer demand for copper and also some mining disruptions, but still some upside for the metal there. Let's check in, though, on how markets in Asia are faring. Sang-Mi Shah joins us now from Hong Kong. Sang-Mi, thanks for joining us. So Trump has left Malaysia for Japan. Now attention is focused on that highly anticipated meeting between Trump and Xi in South Korea. Trump has already predicted that it will go well. What do we expect, though, for global markets?
Yeah, the optimistic outcome of the meeting between the two superpowers would definitely have the market stay that risk-on sentiment that we're seeing already today. And a lot of that reflects back to some of the analysts who said stay risk-on until the end of this month, because they see Xi-Trump meeting as a catalyst to move the stocks further up. And that's also a boon for currencies that's related to the Chinese economy. We're talking about Taiwanese dollars or Korean won as well. But now we're seeing all these moves already. We're seeing the Asia stocks have rallied 1.5% today. The Korean and the Japanese stocks are hitting the record again, renewing their records, and Chinese gauges are up as well. Again, but then if the two leaders do not find a middle ground, that would cause a lot of volatility and a lot of that risk-off sentiment again. And that would also affect some of the defense stocks that we're seeing. And because a lot of that is stemming around these agenda that they have, the soybeans, which is from $13 billion spending from China to U.S., and now that figure has dropped to zero. So those are going to be in the discussion. And of course, top of the agenda would be rare earth, where they're going to be discussing about the curbs from Beijing. So all of these things are affecting markets now, and we'll be watching on Thursday.
Yeah, quite a busy week we have here. Sang-Mi Shah in Hong Kong for us. Sang-Mi, thanks so much. Now let's turn to the Future Investment Initiative being held in Riyadh, Saudi Arabia, where the world's bankers are gathering as they look to claim a piece of the pie to help finance the kingdom's ambitious Vision 2030. Horizon's anchor, Jumana Bersechi, is in Riyadh, standing by with a guest. Jumana?
Yes, good morning, Jen. We're here at FI. We're actually at the Ritz, which is where the FI is taking place. It's day zero. We've got really jam-packed couple of days coming up. We're going to be reporting and anchoring live from here, speaking to some of the biggest names from around the world, some of the industry leaders, and of course, executives who have flown into Saudi Arabia. The backdrop this year, as Christine was just talking about, obviously the maturing of Saudi 2030 and how the kingdom is also looking to reestablish a presence in some of those future industries like artificial intelligence, smart manufacturing, even gaming. So those are the themes coming up. But we are going to be speaking to many financial executives and talking to them about how they are reestablishing or establishing their commitments in the region. And I'm really happy to say that joining me right now is Barclays CEO, CS Venkatakrishnan. I'm used to calling you Venkat. It's really good to have you with us over here in Saudi, Venkat. Let me just start off by asking you quite simply, how is Barclays affirming its footprint in the kingdom?
Yeah. Thank you, Johanna. Thank you for having me. We're very excited to be here. We've been in the Middle East for about 130 years through the region. And in the kingdom right now, we are establishing our regional headquarters. We are in the process of getting all the appropriate investment banking and other licenses, and we're very hopeful that it'll happen quickly. The Saudi government has been extremely welcoming, extremely helpful to us in both telling us what to do and navigating us through it. And we think it's a great place to be. So we're also opening our new headquarters here, which we hope to have set up sometime in the new year.
Okay. Do you have any plans for headcounts for the new office? Can you give us any more details about where it's going to be, headcount numbers?
Yeah, the office will be in the King Abdullah Financial District, and we're getting enough to sort of have a good-sized office. We'll build it up as we get the licenses and as we move.
Yeah. And for me, I mean, when I look back at sort of the evolution of Barclays in the region, it was back in 2014 where I believe the investment banking license was canceled. And then we fast forward almost a decade later, you're coming back into the kingdom. At the time, we reported that there was a lot of competition coming through from some of the local banks. Why is this time going to be different?
Well, Barclays is different, Saudi is progressing, and the UK-Saudi relationship is extremely strong. We represent all parts of that. We have a great global investment bank, and we think it's important to lead with that. We are not here to compete in retail. The Saudi and the local banks have an important role to play in this economy. We're there to help. We're there to provide the connection with the rest of the world, help bring in direct investment, help actually bring in liquidity. You know, if there are reports, you would have seen it, that Saudi banks themselves have so much lending to do that actually this economy could use some foreign lending. We hope to be part of that. And the connection with London, between Saudi Arabia and London, is very old and very deep.
Yeah. Last week around earnings, you did say that you're happy with how the investment bank is doing in terms of, this is a quote, positive jaws, improving profitability, but there's scope to get more done in terms of boosting IPOs, equity-linked business, and M&A. Where does the Middle East fit into that?
It's a very, very important part of it. I mean, you know, there was a lot of activity last year in Saudi Arabia. And actually in the region, you know, the regional exchanges have seen a lot of activity. In addition, their investment flows, and the important thing about investment flows is it used to be out of the region into Europe, into the United States, where of course we have a very strong presence. Now there's a lot coming back into the region. It's two-way. And I think that's the part where we can help.
Yeah, and I saw also that you acted as one of the book runners on the PIF's debut Euro Green Bonds, and what we are seeing is an increased amount of borrowing and issuance coming through from the kingdom. Surely that also presents an opportunity. It presents a great opportunity. The Saudi sovereign, the kingdom itself, is issuing a lot more sovereign debt. Institutions like the PIF, the one you mentioned, have. And it was great for us to be part of that bond, representing as it does both sustainability and Saudi. Okay, so we've spoken about investment banking. How are you viewing the growth of the wealth business in this part of the world as well? So wealth is growing enormously, both the development of regional wealth and then actually the movement of people into Dubai, which is becoming a fairly big offshore center for wealth. We've got a presence there, and I think it is to help people, you know, save and grow for the next generation and the generation after that. That's what the country of Saudi Arabia is doing through its institutions. That's what we want to help the people to do. Yeah, we were reporting on how HSBC's Middle East wealth business was under scrutiny by the regulators, and it's impacted their ability to transact with a number of clients in the region. Do you sense this as potentially an opportunity to pick up market share in wealth?
No, look, I think there's enough room in the region for all the great banks. And what we will do is do it in our own way, in our own style, and hope to serve the region.
Okay, so you mentioned the number of people moving to Dubai, but we also hear, and we report on it on Bloomberg all the time, the number of asset managers, hedge funds moving to Dubai and Abu Dhabi as well. Do you see that as opening up an opportunity in the sense of maybe you can expand your prime brokerage services to cater for all of these asset managers that are moving to the region as well?
That's already happening. We've catered many of them through London, and we will look to follow our clients to where they are. And I think as the critical mass builds, you should expect us to see us do more and more in the region.
Yeah. Okay. So bright spots, bright growth spots around the world. Let's talk about the rest of the world. We have a Fed meeting coming up this week. They are likely to cut interest rates, but you look at U.S. GDP numbers, and we're still printing north of 3%. I mean, how do you see the U.S. economy here?
We continue to see signs of strength. Of course, right now in the month of October, because of the government shutdown, we don't have as much real-time data as we would normally have. And so for those of us outside, it is difficult to handicap exactly what's going on with employment, which is the most important part of this. But we do think that the economy continues to perform reasonably well, that credit conditions continue to be strong, employment, we think, continues to hold. But there is the effect of tariffs, which is a little bit uncertain. So we have to see, but I think the expectation is that the Fed cuts a bit.
Lots of academic circles have been talking about this K-shaped economy and the fact that upper income earners are thriving, but lower income are struggling. Real wages are declining, struggling to keep up with inflation. Are you seeing any signs of that in your consumer business?
We see continued consumer strength.
Okay.
And that consumer strength, which we see both in the UK and the US, comes from people improving their balance sheet. They're being very conservative. So perhaps they're acting as if there's a K-shaped economy because they are saving for the future and savings rates are going up. But I think this is a phenomenon that's been happening over a long period of time. Lots of academic writers have written about it, which is that there's a lot of wealth growth at the high end of the economy, driven in part by the equity markets, especially in the US. I think that's part of the reason why it's important for everybody to participate in the equity markets to the degree they can and appropriate to their own risk level, because it is a source of wealth and it is less represented in portfolios, especially in Western Europe and the UK.
Yeah, that's a very good point. And obviously there's a big budget coming up in the UK later this month, next month. But let me just come back to what I was saying. And the reason I'm asking you about the health of the U.S. consumer is all of a sudden people have started getting a bit worried about credit conditions in the U.S. And my colleagues in Bloomberg last week asked you about certain exposure that you had as a bank. But do you see signs of perhaps credit deterioration? Are you becoming perhaps a lot more vigilant about the type of lending that you're doing based on the Tricolor and First Brands experience?
Well, we didn't have First Brands, we had Tricolor, but we are absolutely becoming more vigilant. Because I think whenever you have fraud, you've got to understand what you can learn from it, what early warning signs there might be, and you have to look across the portfolio. Credit is something you do throughout the cycle. But every time there is an unexpected loss in credit, you have to learn. And I think it's important to be vigilant. We've also said, I've said it many times through this year, that we're at the end of a 15-year-long credit cycle. And so you've got to be cautious as credit cycles go longer and longer and longer. Then you have incidents like this which cause you to be more vigilant. And then we have the economy, which, as we said just now, seems to be at some sort of an inflection point. So all of that tells you you've got to be a little more vigilant.
Yeah, when you look at valuations in credits and equity, do you feel that there's a risk that this is going to fuel more and more speculative behavior and that credit standards are going to begin to get watered down simply because people are chasing returns?
There's always the risk late in the credit cycle that people are chasing returns, as you say. I think on the equity market, obviously there's a part of that market, AI related, which is doing extremely, extremely well. There's tremendous amount of allocation into it. Whenever you have these vast amounts of allocation, there's always a risk of misallocation. By the way, that doesn't mean that shouldn't happen, because people, I think, account for that in their returns forecasts. But for those who are lending, we've got to be careful because the bank is the lender.
Okay, so putting that all together, how do you see the momentum going into the last quarter of the year in terms of just deal making? Obviously, there's a shutdown now, so that's hampering some of the IPO activity. But are these signals positive as we head into the last quarter of the year?
So I think the signals are positive, and I would look at it more fundamentally. We have interest rates which are stable. We've got credit spreads which are still relatively low, so borrowing costs are still relatively stable. And then what is happening with AI and the change in technology is causing lots of companies to look at their business models and see where they can become more effective. It's in part what is spurring a lot of the M&A activity. So we think those fundamental forces will continue through the rest of this year. We've only got 2 months left, and into next year.
Yeah. Since you bring up AI, how is AI altering how you think about your business?
It's altering how we think about it in a fundamental way. We have some very important projects to try to get the best out of it and to understand how to get the best out of it. So there's the technology at one side, there's making it available to our staff, which we have done. And then there is changing end-to-end business processes and doing them through the lens of AI. That is the difficult part. And that's the part that requires a lot of discipline and commitment. And that's what we're trying to do.
Yeah, ultimately, though, so many banks are spending a lot on AI and AI applications. What is the likelihood that you actually get that return on investment? And I think there's this widely referenced MIT paper saying 95% of these AI applications are not generating a return on investment. Do you have to be patient, or do you have to be more realistic in terms of what you can expect?
You have to be selective and patient. And yeah, I think you have to be realistic. So I think, and that comes into the selectivity. You can't just, take a quarter of a process and make it AI enabled and the rest of it not. You can't just have lots and lots of experiments. You have to give it in the arms of people so that they understand what the potential is, and they can, in their own small ways, improve their lives, like we've all done with the internet, like we've all done with the personal computer. But then there are giant processes, which are true in big banks, that you have to fundamentally reshape.
Yeah. Is AI going to replace junior banker jobs?
I hope not. I hope what we do is that we take AI and we make the lives of all of our people more productive. Whether they're junior bankers, whether they're junior traders, whether they are people in operations and in customer service. I think if we look at it through the lens of empowerment and enablement, we will get to a better answer for both the company and for society than if we look at it as a bit of a zero-sum game.
I'm going to ask you one question about the UK budget, because I don't think we're going to get an opportunity to speak to you before the budget happens. Do you think that this budget will be friendly towards the UK banking system? Or do you hope that it will be?
Well, I certainly hope it is. I have to say the Chancellor is here this week. She's here today, leading a delegation, and we'll be part of that. I think this government has been extremely friendly to the private sector and to the financial services sector and to banking. They recognize our importance to the UK economy and to the UK's role in global trade. And so we see this as a joint interest between the country and ourselves.
Yeah. Can you tax your way to growth? Maybe that's
not for me to answer.
Yes. A question for the Chancellor. Venkat, a real pleasure. Thank you so
very
much for fielding all of our questions, and congratulations on the RHQ in Saudi Arabia. That was the Barclays CEO, CS Venkatakrishnan. I'm going to toss it back to you guys.
Yeah, great interview, Jumana. That's Jumana Bersetchi in Riyadh with the CEO of Barclays, CS Venkatakrishnan. Thanks so much for that. Now, coming up, U.S. President Donald Trump has thanked Arab and Muslim nations for pledging billions of dollars to rebuild Gaza, but persuading them to actually hand over the funds might prove tricky. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zapasaja in Johannesburg. U.S. President Donald Trump has thanked Arab and Muslim nations for their willingness to help rebuild Gaza, but persuading them to hand over the billions in funds needed could prove challenging. Gulf states such as Qatar, Saudi Arabia, and the UAE each have their own specific reservations about providing financing. Saudi Arabia feels constrained by lower oil prices, while the UAE wants greater clarity on the situation. For more, we are now joined by Dan Williams in Jerusalem. Dan, thanks so much for being here. Maybe you can walk us through how much we know, potentially estimates, how much will it cost to rebuild Gaza?
We've heard $70 billion. We've heard $50 billion. We've heard as much as $100 billion, depending how you ask. It's worth remembering that a sizable chunk of that final amount would go just into moving away the tons and tons and tons of debris that have gathered there, the physical excavation, the clearing of unspent ordnance, truly a mammoth task. And President Trump's plan for turning the current ceasefire into a long-term peace, a peace that he would like to spread from Gaza to the rest of the Middle East, faces no shortage of challenges. One of the challenges, as you noted, as ably argued by our colleague Sam Dacher in that weekend report, is getting donors to come up with those tens of billions of dollars so his plan can be put into action on the ground. The earth movers can come in, the reconstruction teams, the zoning teams, and perhaps one day, years into the future, put Palestinians in Gaza on a path towards something resembling a normal life, a pleasant life, a life approximating to the Gaza Riviera that the president was talking about just a few months ago.
Right. But as we were mentioning, there are still some concerns from some of these Gulf states about the funds. Can you give us a sense of maybe the top lines from some of the concerns that you've heard?
Sure. Well, the focus of Sam's reporting was on the three economic powerhouses of the Gulf, Saudi Arabia, United Arab Emirates, and Qatar. Each of them has signed on to this Trump plan very enthusiastically and publicly. Each has a different set of interests. Saudi Arabia, an oil powerhouse, is looking at the falling oil prices. That may pinch its fiscal abilities, its abilities to come up with a significant amount of money. For UAE and Qatar, the interests are also geopolitical, potentially vectors which are in different directions. We have UAE, which very much wants to see an end to Hamas rule in the Gaza Strip, much like Israel and the United States, wants a guarantee of that before it invests in Gaza's future. Qatar seems to be more interested in what Israel would do and what Israel would commit to as part of its promised disengagement from the Gaza Strip, and an assurance that long-term there will not be a renewal of fighting in Gaza, certainly not as destructive as Gaza has seen in the last 2 years. It's also worth remembering that Qatar has historic ties to Hamas, has been hosting their headquarters in Doha for a number of years. So a lot of moving parts here, and it will take the best of Trump's abilities as a deal maker, as a retail politician, to get all of those parties, all of those powers to sign on the dotted line, to sign the checks, to make sure they clear in time to put his plan into action.
Bloomberg's Dan Williams in Jerusalem. Dan, thanks as always for your reporting and for joining us there. Now, coming up, has gold lost its luster? As the precious metals decline continues, we'll discuss what's driving the drop next. Stick with us. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks rallying on signs the U.S. and China have hammered out a trade deal. Focus turns to the meeting between Presidents Trump and Xi for final approval.
We've created a framework for the two leaders to discuss on Thursday in Korea.
We're live in Riyadh this week for the Future Investment Initiative with the world's top bankers, world leaders, and executives gathering to explore the future of global investment. Plus, vote counting is underway in Ivory Coast, where President Alassane Ouattara is expected to win a fourth term after a disputed election that excluded key opposition figures. It's just gone past 9:30 a.m. across the Emirates, 7:30 here in South Africa. I'm Jennifer Zabisaja in Johannesburg, in for Jumana Bersechi, who is in Riyadh this week for the 9th annual FII conference, as we just heard from her. And the focus really today is on that potential trade truce that we are seeing between the U.S. and China. We still have to wait for that meeting between the two leaders later on this week, but definitely seeing positive sentiment being filtered into the markets right now. Let's just take a look at where U.S. equity futures are, because they ended the week last week, U.S. equities ending the week in positive territory after we did see that softer than expected U.S. CPI print. Then we got positive news potentially on the U.S.-China trade front moving into the week. And we still have a number of corporate earnings later this week, as well as a Federal Reserve meeting. So plenty for the markets to pay attention to. S&P futures up just about 0.8% there. The U.S. 10-year yield is also back up at 4.0372. We should note just a few days ago we were talking about U.S. 10-year yields reaching the lowest level since April, but potentially we do see bonds having a bit of a vulnerability shock, as our Markets Live team suggests, as a trade truce potentially signals positive global growth. Brent crude right now pairing some of the earlier gains that we saw in the session, but up just about 0.4% there at $66 to 24 cents a barrel. And gold pulling back from its highs, down just about just below 0.8% there. And as Anne Sebastian, who was our guest earlier, alluded to, potentially this is a bit of profit taking, but then also potentially safe haven demand is waning. Let's get to our terminal chart, which digs into copper. We were talking about gold and some of the moves that we're seeing there. It's a different story for copper, advancing towards an all-time high, but still there is some concern feeding into the metal on softer demand in Asia and China and potentially mine disruptions. But still, the energy transition is helping lift sentiment for copper, seeing a bit of strength as the day stands right now. Let's, though, pivot to how Asian markets are faring with Winnie Xu, who is in Hong Kong for us. Winnie, give us a sense of what you're watching.
Yeah, it's a really positive session in Asia today, especially when we look at what's going on in the Chinese assets right after this development between U.S. and China trade talks. So you can see how on the board that we've got both onshore and offshore stocks gaining about 1%, with the offshore yuan actually strengthening a little bit as well. So a lot has really happened over the weekend, but we are really excited, or investors are really excited about how China is finally also on that same page, and that's setting a very positive tone ahead of the actual meeting between President Trump and Xi. Now, we are seeing sector-wise that these shipping stocks are gaining, while the soybean makers are actually falling in China because of the expectation for China to now buy more soybeans from the U.S. Now, taking a look at how it's spilling over to the broader Asia market, because we are seeing this risk-on sentiment in the Asia session with the gauge, the broader Asia stocks, and also Japan, South Korea touching their fresh new highs on this, with the Nikkei now past that 50,000 level and the Kospi over 44,000 milestones. So overall sentiment is really strong, with the emerging Asia markets also rising after Trump said that he's made some of these trade deals with the Southeast Asian countries. Now take a look at what's going on currency-wise, because we are also seeing a nice tailwind there for the Asian currencies, most of them strengthening against the U.S. dollar, and especially those riskier ones like the Korea won, but also the ones that are seen as China proxies like the Aussie dollar and the Kiwi dollar also gaining more ground here.
Winnie Xu in Hong Kong for us. Winnie, thanks so much for the latest there. Let's stick on our top story, though, as Winnie was just alluding to there. In a sign of thawing relations ahead of the Trump-Xi meeting this week, U.S. Treasury Secretary Scott Bessent says he expects China to defer its rare earths export curbs. This comes as top trade negotiators for the U.S. and China set the stage for their leaders to finalize a trade deal. Let's bring in Bloomberg's chief North Asia correspondent, Stephen Engel, who has been following this story. Stephen, give us a sense of what the scene is like and what the mood is like really on the relations between these two economic powers.
Yeah, that's right. So I'm in Tokyo right now. So I'm on the next stop of Donald Trump. We're kind of trying to keep one step ahead of the president as he is now flying from Kuala Lumpur, Malaysia, up to Japan, where he'll have essentially 2 days here. He'll meet the new prime minister, which will be a dynamic, relationship in its own sense, not just the Xi and Trump meeting on Thursday in Korea, which I'm also heading off to Korea after being in Tokyo, of course. But again, the backdrop of this short visit to Tokyo, is that agreement in principle, the framework agreement of a trade deal between China and the United States, where Scott Bessent, who will be traveling with the president to here in Tokyo after Malaysia, is essentially saying that effectively they're going to put take that threat of an additional 100% tariff on China off the table because of at least what they've been told by their counterparts across the table in Kuala Lumpur. The Chinese negotiating team is that they will defer their regime of export controls on rare earth minerals. They got also kind of a hint, if you will, that China is willing to again resume buying of soybeans, which has become a political hot button issue in the United States, in particular with Trump supporters, farmers in the Midwest. China had not bought a single cargo order of soybeans since the harvest began essentially in the beginning of September. So that's become a sore spot for the Trump administration. It looks like they might have gotten a concession. There's a number of other issues on export controls that the two sides have essentially agreed to, as well as the fentanyl issue. We have to find out the details of what China has pledged on fentanyl, because that basically attracted a 20% additional tariff by the United States, because Trump didn't believe China was doing enough on the fentanyl issue and the precursors shipped across the Pacific, allegedly, of course. And then they've also seemed to find ground on relieving both nations, imposing those levies on ships calling to port in both countries. So that looks like they got a lot done. Now it has to be hammered out and signed and agreed upon by the two gentlemen when they meet in Korea in just 2 days' time, where we will be as well.
You're traveling all over, and we appreciate that. Stephen, is there optimism that this time we will, in fact, see tensions simmer for real, for good this time?
Well, again, the issues between China and the United States are numerous, and it's not going to be resolved. There's no panacea pill, if you will, to resolve the issues. They are competitors, strategic competitors, and some have said adversaries. But again, if they can bring the temperature down, build on the relationship that Trump says they have between him and Xi Jinping, that is a good thing. That's why the market's acting as a proxy to what seems to be a little bit more goodwill. You saw He Lifeng, the top trade negotiator of the Chinese, coming out of those meetings with a broad smile. He has a ready smile anyway. He's a fairly jovial individual, at least to the camera. So that gave a good sign that the Chinese side is willing to work with the Americans. And going forward, we just have to see what the dynamic is going to be 2 days from now in Korea between Xi and Trump.
Stephen Engel, thanks as always for your reporting. Great stuff, and we'll be following your movements all week. Now, as Stephen was just alluding to there, traders are tracking gold prices as progress on a U.S.-China trade deal saps haven demand. This comes after the precious metal posted its first weekly drop since mid-August. Meanwhile, oil trading higher this morning as the deal boosts sentiment on the demand outlook. This is offsetting concerns of a supply glut. Joining us is S&P Commodities Insights President Dave Ernsberger. Dave, thanks so much for being here. So we are seeing positive sentiment in the markets right now. Is it perhaps premature? How are you assessing the current sentiment?
Thanks, Jennifer. Well, the oil market has almost the exact opposite reaction to an improving relationship between the U.S. and China than the gold market does, as we were just hearing there in the gold price. The oil price, conversely, is up. And one of the reasons for that is that when you put demand for oil from the United States and China together, they actually account for nearly 40% of world oil demand. So any change in the relationship between the U.S. and China, particularly one that is supportive of economic growth and therefore supportive of stabilized or stronger oil demand, is going to have an outsized impact on the price of oil. Having said all of that, an outsized impact on the price of oil is just the kind of move you're seeing on screen here today, which is up about 0.5%. That tells you that the market is still dealing with some pretty significant overhang of supply issues, which are really in the background, keeping a lid on any positive reaction here.
Do you think then, Dave, we'll see sort of a cap on some of the upside momentum for oil at this point, considering the overhang you just mentioned there?
Yeah, there's a pretty significant issue in the oil market that suppliers are working their way through, which is OPEC Plus has been bringing production back to market at the same time that demand has been growing at a fairly moderate pace. This means that total available supply to the market is probably growing in the order of a combined 1.5 to 2 million barrels a day over the coming 12 months, at a time when demand is really only growing by 800,000 barrels a day to maybe 1.2 million barrels a day. So you can see that there's almost twice as much supply coming to market as there is demand coming to market, and that in the background needs to be cleared by the market somehow. We can already see that inventories are growing for crude oil in the fourth quarter. That's not unusual. We're not surprised to see stocks growing. They usually do this time of year. But the market needs to find the clearing price, which will find balance again. That's generally speaking the price at which U.S. production would start to fall. So we still expect oil prices would fall below $60 a barrel after the turn of the year.
That's what I was going to ask next, Dave. What is key to the price action moving forward? Is it potentially increased production from the U.S.? Is it demand in Asia? Is it OPEC Plus? How do you look into it?
Well, generally speaking, demand is kind of growing at a subdued but stable rate of that sort of close to 1 million barrels a day level. So we sort of take that as a starting point for thinking through supply and demand fundamentals. The biggest wild card, Jennifer, is actually what happens with Russian supply into the market. This is the big wild card out there, which could turn the market on its head a little bit and put more of a bullish impetus behind prices. As I'm sure you've been covering, as most of the world's been looking at, the new U.S. sanctions on Russian oil suppliers is having a big impact on how people are thinking about supply. To give you an example of what that means, India consumes about 6 million barrels a day of crude oil, give or take. Around a third of that is supplied by Russia. So if India does need to scramble to find a fresh supply of, let's call it 1.5 million barrels a day of oil, and that starts to pull from other sources, and if that Russian oil effectively gets locked in, that would rebalance the market very, very quickly indeed and have a bullish impact. So the effect of Russia sanctions is the wild card right now, and where the market goes, we'll find out towards the end of November as those sanctions start to be implemented.
What do you look for then? Is it waiting for the implementation? Is it more rhetoric out of the U.S. And other nations?
Yeah, it's the implementation is the key there, Jennifer. I think that people are trying to keep their eye on the ball here, including our researchers and analysts, by not leaning too hard into the rhetoric, because the rhetoric is very strong and can be very distracting. It's part of the process. But at the end of the day, how those sanctions are implemented and how buyers of Russian oil respond to that is the key for where prices go next here. It's a complicated picture in the sense that not every barrel of Russian oil that gets exported moves on a ship is visible to the international eye, and so we won't see a full impact of these sanctions on total Russian exports, but quite how impactful they are, and particularly that Russian question with into India of 1.5 million barrels a day, and what Turkey does, which is almost 500,000 barrels a day. Those are the kinds of questions on implementation that we'll be watching very, very carefully.
All right, we will leave it there with you. S&P Commodities Insights President Dave Ernsberger joining us from Riyadh. Dave, thank you so much for sharing your insights this morning. Now, coming up, vote counting is underway in the Ivory Coast after presidential elections. More details on that next. This is Bloomberg. welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasanja in Johannesburg. Vote counting is underway in Ivory Coast, where President Alassane Ouattara is expected to win a fourth term after a disputed election that excluded key opposition figures. The election has been criticized as a setback for democracy after a constitutional change in 2016 allowed Ouattara to seek 2 additional terms. For more, Bloomberg's Ndiro Oganga is joining us now from Kigali. Ndiro, how pivotal is Ouattara's re-election going to be for the country's economy and also political stability?
Hi, Jennifer. So for context, Ouattara has been able to stay in power this long because of how well he's been able to manage the economy ever since he took power. Ivory Coast has become one of the fastest growing economies in the region, 6% annual growth. And this is anchored on a few things. It's anchored on infrastructure development. It's also anchored on the country's oil deposits. And this confidence is beginning to be reflected in how investors are perceiving the country's bond. This is a country with one of the best performing bonds on the African continent, with yields under 10%. And we are looking at a country with low cost of living, high standards of living. And so this election might not be pivotal, but it's very essential for continuity. Ouattara says that he's going to invest in infrastructure, expand access of electricity across the country, expand mining, ensure that manufacturing contribution to GDP increases. And this re-election has sort of gotten a nod of approval from the markets, because if we look at their bond that is due in 2036, yields dropped by 70 basis points. However, there are concerns. This win brings short-term relief, but when we look at the long-term, this is a country that is taking infrastructure-heavy, or rather capital-intensive projects. Infrastructure mining are long-term projects, and so they need independent, strong, credible institutions and also political predictability. But we're dealing with a country where the succession plan is not clear. They've heavily suppressed opposition, and so this democratic regression is going to be a problem in the long term.
That is one of the many concerns, Ndiro, democratic regression, not just in the Ivory Coast, but more broadly. How do you see this re-election maybe speaking to that if we take a look at West Africa?
It's actually borrowing a leaf from the playbook that we've been seeing happening. If we just contextualize Ivory Coast, Ouattara was going to win this election. He barred the main opposition candidates from vying who could have given him a run for his money in this election. The other 4 candidates that were vying stood no chance. This is also a country that has a history of a civil war, so there were no protests, and even the opposition leaders who had been barred, they had to practice some form of responsibility towards the country so that violence does not ensue. And if you look at the greater region, this is what is happening. Military coup leaders are changing the constitution to ensure that they can democratize the military coups and become democratically elected leaders. Then you have leaders like in Togo and Cameroon who've changed the constitution to allow them to become lifelong presidents. In Cameroon, if Biya wins, by the end of his term, he'll just be a few months shy of becoming a centenarian president. And all this is happening under the nose of ECOWAS. They're yet to hold any of these leaders accountable. Anytime they tried, we saw other military leaders break away and form alliance of the Sahel. So when there's no punishment or when there's no pain point for these acts, we are likely to see them continue to happen in the region.
Yeah, there's quite a bit to pay attention to, and you, of course, mentioned there Cameroon, which we're still waiting for those election results. But Bloomberg's Ndiro Oganga in Kigali, Rwanda, giving us the latest on the Ivory Coast election. Now, coming up, the South Korean president tells us Seoul and Washington remain stuck on the details of a $350 billion investment pledge. That conversation's next. This is Bloomberg.
The negotiations between Korea and the United States are proceeding in 2 areas of security and economics simultaneously. Negotiations in the field of security issues are going very well, but negotiations in the area of economics, especially trade, have reached a preliminary agreement, and we're in the process of hashing out the details. The discussion is ongoing and there are some differences of opinion, but the delay does not necessarily mean that this is a failure. We already have a comprehensive agreement, and we're currently working on the details. So I would appreciate your patience.
When it comes to Japan's deal, there have been some divergent interpretations. Is South Korea trying to make it more specific than Japan's? And if that's the case, could that become more burdensome for Korea later on?
대한민국은 일본이 아닙니다.
Korea is not Japan. I do not fully know what deal the US and Japan have struck, but from our point of view, we have our own circumstances, and we will reach a rational result that suits us. Of course, the example of Japan or Europe could be a base that we can refer to, but in the end, we must find a way which takes into account Korea's circumstances, that is acceptable to Korea and also helps the United States in its manufacturing renaissance. As we search for a mutually beneficial path, there will be differences as well as alignment of opinions.
In finding common ground, could the size of the U.S. investment fund become smaller?
투자의 방식,
The method of investment, the amount of investment, the timeline, and how we will share the losses and divide the dividends, all of these remain sticking points. The US will of course try to maximize its interests, but it must not be to the extent that causes catastrophic consequences for South Korea. The United States is the leading country in the world when it comes to democracy and rationality. South Korea is an ally and friend of the United States, so we believe that we will be able to reach a rational result that is acceptable to all sides, and this is what has to be done.
A highlight of the APEC summit is the upcoming meeting between Presidents Trump and Xi Jinping. How important is this dialogue for South Korea?
한국은 지금 공급망을 둘러싸고
When it comes to the supply chain, the world is divided into two blocks facing off each other, one led by the United States and one by China. Korea is situated both geographically and economically between these two. We are situated in between two grinding stones. It's a situation akin to having both arms pulled by China and the United States. This is both a challenge and an opportunity. We cherish our baseline policy emphasizing the Korea-US alliance and Korea-US-Japan trilateral cooperation. At the same time, we do not seek to sever ties or pursue excessive confrontation with China or socialist nations. Korea will continue to cherish and emphasize its alliance with the United States, and at the same time manage its relationship with China.
That was South Korean President Lee Jae-myung speaking to Bloomberg's Sherry On. Well, let's take a quick look at the markets. It is a risk-on day, as we were mentioning earlier in the show. Potentially some positive signs coming from U.S.-China trade talks, but still quite a bit to pay attention to for the week. But that is where we'll leave it here for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.